As social media, technology, and life in general evolves, it makes being in control of our finances in our 20s a lot easier. But it can also come with some unforeseen traps. And in your late teens or your 20s, you probably finally start making your own decisions, you get your first real paycheck, you feel independent for the first time. But at the same time, you're surrounded by people who are probably your age or a little younger doing things that look like success. They have the new fancy cars, they go on trips, they got the flashy lifestyle, they have risky investments and side hustles that they promise you will get you free in life, get you financially free. And usually that is accompanied with promises that make you money easily, right? You can 2x, 3x your money in a day, in a week, or a month. When in reality, most of these are likely financial traps that you can avoid or learn the hard way and fall into. I know in my early 20s, before I started taking my finances seriously, I definitely fell into a few of these traps myself. So in this video, I want to go over these different financial traps and how you might come across them and why you should avoid them in general. So let's go ahead and let's get into it. First on the list is gambling. And gambling today doesn't look like what it used to. It's not casinos anymore or sketchy back rooms anymore. It's literal apps on your phone, ads during every single game you watch, sports betting everywhere, and even Polymarket, where you can bet on literally anything happening in the world with cryptocurrency. And the worst part is that pretty much everyone calls it entertainment instead of what it actually is. And that's why it gets so popularized in your 20s, especially today. Sports betting especially feels very harmless in the moment. You're usually already watching the game anyway, so throwing 10 or 20 bucks on it feels like you're just making it more fun. And your friends are doing it, group chats are full of parlays, and every commercial you watch makes it look normal. And it's like almost expected nowadays to have a bet riding on every matchup you watch. And this is where it becomes a major financial trap. The first problem is that gambling is always designed to feel low risk while being statistically stacked against you. The odds will never be in your favor long term. No matter how much research you think you're doing, the apps are built to keep you playing. You always get free bets, you get instant deposits, you get flashy wins, incentives, you have celebrities promoting it, and all of that is to mask the fact that consistent winners are extremely rare. I mean, I watch a lot of football, and I missed on a lot of hits when I was in my early 20s trying to make a quick buck. And the second issue is how the losses add up. It's rare that one massive loss is what gets people in trouble. The big problem is the constant drip. The $10 here, the $20 there, the $50 on like a lock. Like, I know it's going to happen, I'm putting 50 bucks on it. And over a year, that turns into thousands of dollars that could have been invested, saved, or used to actually improve your life. And the most dangerous part, it rewires how your brain looks at money. When gambling becomes normal, money stops feeling like a tool and starts feeling like chips in a game. So those wins, when you do win, it feels very euphoric. But losses make you feel like you just need one more bet to make it back. And then all of your financial decisions after that are being driven by emotion instead of logic. So at the end of the day, look, gambling promises fun, it promises excitement, and it promises, 2x, 3x quick wins on your money. But what it really delivers is inconsistency, a lot of stress, and a lot of loss in momentum with your finances. So look, if you want to gamble for entertainment, do it for entertainment. But if you want to gamble for wealth, you need to avoid those systems that slowly extract money from you. And the next thing on the list is just your classic day trading and get rich quick investing that we see all over social media. And day trading and get rich quick investing sounds different from gambling. And that's why so many people fall into it. It feels smarter, right? You're no longer betting, you're analyzing markets. You've got charts, you got indicators, you got Twitter threads, you got Discord groups, and you got someone explaining why the next move is high probability because all the research they did. And in your 20s, this is incredibly appealing. You don't have much capital yet, so slow growth feels extremely pointless. You're like, why am I even doing this? Like, who cares about 8% returns, right? So waiting decades for compounding does not feel exciting. When you're watching people online turn $50 into a, $200,000 portfolio in massive overnight moves. And it creates this pressure that you're not aggressively trading enough, and therefore you're falling behind. And that's where the trap comes from. Day trading sells you this idea that knowledge equals control. But the reality is you're competing against professionals, You're competing against institutions and algorithms that move way faster than you ever could. So even if you win a few trades early, that initial success is often the most dangerous part because it builds this false confidence and convinces you that you've figured out the market. And the real problem isn't just losing money, it's inconsistency. You might have one great week. Look, I'm not going to deny that people don't make money from day trading, but then you could easily give it all back the next. And while you're glued to charts and reacting to every single candlestick movement that you see, you're paying that invisible tax, right? You're paying the stress, the emotional swings, and the constant second guessing that you know what you're doing. And your mood will start to follow the market. Wins feel amazing and losses feel personal, and you just want to quit everything. And here's the part that a lot of people don't talk about: the opportunity cost. The hours spent staring at a screen could have gone towards building real skills, increasing income, improving health, or just investing stress-free and consistently in boring assets that actually have been proven to work long-term instead of trying to compound wealth overnight. And that is why this is a financial trap. The get-rich-quick investing doesn't fail people because they're lazy. It fails because it relies on speed, it relies on emotional control that people usually don't have. And while yes, day trading promises you this freedom, it usually delivers a lot of burnout and just a lot of frustration in smaller accounts, especially when you first start. So if you want real wealth, you definitely don't need excitement. You just need consistency and avoid strategies that require you to be perfect just to break even. The slow path is not flashy at all, but it's stress-free, it's easy, and it's been proven to work over time. The next trap is something that's it's just far too common nowadays too, especially with social media and everyone trying to have a personal brand, and that's buying courses instead of building skills. Look, buying courses, it feels very productive, right? You're not really wasting money. You're investing in yourself, and at least that's how it's sold to you, right? You'll see a clean landing page. You got this confident creator who's giving you a 2-minute high-level overview of their course. And then you have a lot of reviews showing someone's life, how it changed their life completely, and now they're a 6-figure investor. And suddenly dropping a few $100s feels like a smart move if you can turn it into $1 million. And in your 20s, this trap is just everywhere nowadays. Look, we all want direction and we all want a shortcut. There's no hiding that. And you just want someone to tell you exactly what to do so you don't have to waste the time and figure it out yourself. And courses promise you that, right? They promise you the clarity, the structure, and the results, all without the discomfort of that trial and error. But that's where the trap lies, because most courses don't fail because the information's bad. I'd say most of the people who do these courses, I'd say the information's pretty decent. Probably all comes from ChatGPT, but it's probably pretty decent. But they fail because the information without execution is useless. You watch a few videos, you feel motivated, maybe take some notes, and then the real life actually happens. The course sits unfinished while the next better course gets marketed to you. And that creates this cycle of continuing, buying courses to make more money or learn new skills. And another issue is that many of these courses are repackaged basics. You're paying this premium price for information that you could just go on Google and sit on Google for 3 hours and learn more in 3 hours on Google than you would with this whole 20-hour course that some 20-year-old in a penthouse in Miami is trying to sell you, right? So they're more so selling you the dream that you can actually make money than actually doing it yourself. And the real cost isn't the price of the course, it's what it delays, right? Every time you buy a course, you're pushing off actually starting because you convince yourself that in reality you're preparing, when in reality you're actually just avoiding the uncomfortable phase of being bad at it at first and learning yourself and trying to build these skills yourself. You just rather pay someone to teach you how to do it. And that skill, right, those hardcore skills we need, they thrive in repetition, in mistakes, and feedback. So we have to make those mistakes ourselves at first. And, courses can be useful, right? I'm not saying they're all financial traps, but I would say only after you've already started your journey. Buying education without action, it gives you this illusion of progress while keeping you exactly where you are. So if you want results, in my opinion, I would build the skills first, and I would do as much research as you can first that's free. And at that point, if you feel like you really need a course to help you out, then at that point, it's on you. But for the most part, no one should be paying hundreds to thousands of dollars a month to get someone who's 18, 20, 22 years old to teach them something, because more than likely we can learn all the same information we want to online by ourselves for free. And the next trap is buying things to look successful. Look, at some point, you're all going to be tempted, and I was definitely tempted to buy something that makes you look successful. And it's one of the easiest traps that people in their 20s fall into because it doesn't really feel irresponsible, right? You're not blowing money, you're upgrading. A nicer car, better clothes, maybe the newest phone, more expensive apartment. And on the surface, you tell yourself it's progress. And in your 20s, that pressure to progress is everywhere. Social media has turned success into something visual, right? If it looks good on Instagram, people are going to assume you're doing well. And when everyone around you seems to be leveling up, it's easy to feel like you're the one who's not keeping pace, even if your finances are actually doing pretty good. And that's where that trap starts to begin. And most of these purchases aren't made because they actually add real value to your life. They're made to signal status. And the problem with status is that it's expensive and it's temporary. There's always going to be something newer, something better, and something flashier out there. And trying to keep up turns into this never-ending cycle of spending. And the biggest issue is that these purchases lock you into higher fixed costs. So car payments, insurance, maintenance, rent, subscriptions, worst case, buy now, pay later. And once you upgrade your lifestyle, it becomes very hard to downgrade because that money isn't flexible anymore. It's committed. And committed money is the enemy to financial freedom. So what makes this especially dangerous is timing. Your 20s are when small financial decisions have the biggest long-term impact. Every dollar you spend trying to look successful is a dollar that's not compounding and not giving yourself future options. So you're sacrificing long-term wealth for short-term validation. And looking successful and being successful are two very different things. Real success is boring early on. It's quiet, it doesn't show up on social media, but it shows up in low stress, flexibility, and options later. So if you want to win financially, delay the image and build that financial foundation, because the confidence that comes from financial stability will always outlast the confidence that comes from buying things to look flashy. Next up on the list, and this is one I definitely fell for, is buy now, pay later and easy monthly payments. Look, buy now, pay later sounds super harmless, and that's why I did it. It doesn't even feel like debt, right? You're not swiping a credit card, you're not taking out a loan. You're just breaking one purchase into smaller, manageable payments. And $25, $50 today feels way better than paying $300 up front. And that's why recently it's exploded in popularity, not only because things are more expensive, but because it's just way easier to, mentally use a buy now, pay later system. And in your 20s, cash flow really matters to a lot of us. So if you want nice things, but you don't always want to wait for them, these services make it feel like I can just own whatever I want at the tip of my fingers because I don't need to fork out the money right now. So you don't see any big hit to your bank account and you get that instant gratification. But this is where it becomes the financial trap, because the problem isn't one purchase, right? If you have used it before and you just buy one thing on it, it is what it is. It's stacking payments, because each small monthly charge feels insignificant on its own, but together they're going to quietly eat up your income. And before you realize it, a chunk of your paycheck is already spoken before it even hits your account because you have it wrapped up in buy now, pay later. And the other problem with this is you're more likely to say yes to things that you know you can't afford and therefore would have skipped buying if you had to pay it in full. And that changes your spending behavior entirely. Because instead of asking the really tough question of, can I afford this? You start asking yourself, can I afford $25 a month? And let's be honest, we probably all can afford $25 a month. And that mindset shift is really dangerous to your finances. Another issue is that it trains you to normalize debt for non-essential items. So now you're taking on debt for clothes, for gadgets, for furniture, maybe even food or groceries. And things that used to require you to save and now buy, you can easily finance. And that habit carries over into bigger decisions later where the stakes are a lot higher. And the main trap is that a lot of people think mentally that buy now, pay later is making that item cheaper. But it just makes it easier to say yes to, especially if you're paying interest on this, because now you're just making the item more expensive than it was to start with. And when your money is already committed to a past purchase, it becomes harder to invest, save, and take advantage of certain opportunities when they come up. So if you can't afford it outright, I would pause and just wait. I would give it 24 hours to 48 hours and decide if you really want that item in the first place. And then if you really do want it, wait till you can pay for it in cash, because holding that is going to be one of the best things you can do for yourself, and getting into buy now, pay later is really going to set you back financially. Now, the next trap I got for you guys, and this kind of ties back into buy now, pay later, but it's in your 20s and late teens or whatever age you're at in life, is thinking debt is normal. And one of the biggest financial traps in your 20s isn't even a purchase, it's a belief. That idea that debt is a normal part of life, everyone's been told that debt's unavoidable and everyone has it, almost like it's something you're supposed to carry with you. And honestly, it makes sense, right? The world we live in, having debt and making it normal makes sense. Debt's everywhere. Everyone's got student loans, car payments, credit cards, buy now, pay later, subscriptions. And it's so common that not having debt almost feels unusual, right? Society treats it like it's a default setting, right? Like we don't have the decision to not have debt. But that's why it's a trap, because when debt gets this normalized, you stop questioning it. You don't ask yourself whether something is worth financing, you just assume it's worth financing. And payments become kind of that background noise that revolve your finances. And your future income gets pre-spent before you even earn it. And that danger is not just the interest, it's the loss of flexibility with your finances. Because debt is going to limit your options. It keeps you stuck in jobs that you don't love. It delays investing. It adds pressure to every financial decision. And it makes setbacks feel like probably the worst things you can ever experience. And when most of your income is already promised to your past choices, your margin for error disappears. At that point, you can't afford to lose your job. You can't afford to take vacation. You can't afford to not work overtime. And what's even worse is how early it starts. Small debt in your 20s turns into habits that follow you into your 30s and 40s. And because payments feel manageable, people underestimate how long those payments will stick around. Years pass. Your income increases, but so do the financial obligations to your debt. And that freedom never truly arrives at that point. So debt is not unavoidable. It's contextual. Some debt can be very strategic, right? I'm fully aware of that. But treating all debt as normal keeps you from ever questioning whether you actually need it. And that financial progress isn't about keeping up with payments. It's about creating breathing room. So if you want leverage in your life, protecting your cash flow and guarding your flexibility is one of the most important things you can do. And normal does not mean optimal, right? And just because everyone else has debt and everyone's normalizing it, it doesn't mean it's leading you down the right path. So if you have the option to avoid debt, I would do that as much as possible. Now, the next trap is one that I really like because I feel like this is probably the most slept on one, and people underutilize this to the max. And that's treating your raises and bonuses as fun money. And the first raise or bonus you get is going to feel amazing, especially if this is like your first big boy job. Like, it's going to be a decent amount of money. And it's proof to yourself that you're moving forward. You worked hard, you earned it, and for the first time, there's extra money that wasn't there before. So it feels natural to celebrate. And that's where this becomes a trap, because raises and bonuses often get treated like free money, right? Like, that money doesn't count. If I get a $5,000 bonus, that's $5,000 I can spend. Since you were fine before it, and now boom, it's in your account. So it doesn't feel like spending this money is risky. So lifestyle, creep's going to creep in, and you're probably going to spend that money on things you really don't need. And that money shows up before you have a plan for it. And if you don't decide where a raise goes ahead of time, that lifestyle inflation is going to decide it for you. And the extra income will slowly disappear into higher fixed costs, and suddenly your financial situation feels the exact same. It doesn't even feel like you got a raise, and worst case, it gets more expensive. And when your income increases again, that cycle is going to repeat. So we need to fix this, because bonuses are even worse, because since bonuses are irregular, people mentally label bonuses as splurge money instead of opportunity money. But bonuses, in my opinion, are some of the most powerful dollars you'll ever earn at work, because they can be deployed intentionally towards investing, towards debt elimination, emergency funds, and future flexibility. So raises and bonuses, in my opinion, should not be treated as rewards. They're leverage for your financial foundation. They're your chance to accelerate progress without sacrificing your current lifestyle. And that's really powerful, because treating them like fun money feels good short term, but it's going to delay all your freedom in the future. So I'm not telling you to not enjoy your money. You should 100% enjoy your money, but just be intentional with the first move. If you want to split your bonus up or split your raise up, you could even do that as well. Just decide where those increases go before they actually hit your account. And the last trap here is thinking that I'm young and I can fix this later. And look, I'm 25. This was the mindset I had, and I know a lot of people, when it comes to being young, they look at their finances and they think it's stupid, they think it's boring, they think it's too restrictive to care about your finances while you're young, and they think retirement's so far away and they'll never retire and X, Y, and Z. But in my opinion, out of all the traps, this is the most dangerous trap, because this one sets up your mindset for failure. Because I get it, you're young, you've got time, you can enjoy life now, and you'll clean everything up later. Nothing will ever feel urgent in your early teens or your early 20s. So putting off things that don't feel like a big deal, it's easy. And honestly, once again, the logic makes sense. I thought like this all my early 20s is how I thought. And in your 20s, the consequences are never immediate, right? Missed investments, they don't hurt right away. Bad spending habits, they don't feel heavy yet. And you can recover from mistakes faster, so it feels like there's always room to delay getting serious about your finances. But time is that one advantage that you'll never get back. And when you delay building good financial habits, you're not just postponing progress, but you're shrinking that financial runway that's in front of you. I think the best way to look at this is that small actions, small imperfect actions taken early will always beat perfect actions taken late every single time. So years pass faster than you expect. Income increases, responsibilities stack up, and suddenly fixing things isn't just about discipline, it's about undoing damage. Your debt grows, expenses get higher, and the habits you meant to fix have hardened into default parts of your life. And what makes this especially tricky is nothing forces you to stop. There's no alarm that goes off one day and it's like, hey, it's time to get in control of your finances. Life will keep moving. And the costs only show up years later when you realize how much easier things could have been if you just started sooner. If you just started investing $5 a day, $10 a week, $50 a month sooner, everything would have been easier. So being young, in my opinion, will never be an excuse to not care about your finances. Being young is the best time to leverage the time in front of you. Your 20s are when effort compounds the most. You don't need to be perfect or aggressive or even extreme. You just need to start simple, basic financial habits. Even if it's something as simple as just building a budget, that's a great step. I'm not telling you guys that you need to become Warren Buffett overnight and you need to invest everything in VU. It's just putting money in the forefront of your mind and thinking, do I really need to make these pretty dumb financial decisions? So avoid the belief that future you will magically fix what present you is spending your money on. The best time to build that foundation was yesterday, and the second best time to build it is today. So that finishes off the list of some of the biggest financial traps that I believe you'll come across in your 20s, and some of these will pop up in your later teens. They might even pop up in your 30s. The point is, we need to figure out how to navigate these traps when they pop up. And for me, this is a very personal list. I pretty much fell for every single one of these traps. I tried day trading. I've had my fair share of sports betting. I've done the whole I'll wait till I'm later. I've spent my bonuses on car parts. So I've done all of these things, right? So maybe I'm speaking from experience here. But if you do fall for some of these traps, there's always a way out of it, right? You can always get in control of your finances and just make your life a little bit easier. But let me know in the comments down below. Did I miss any traps? Have you fallen for any of these yourself? Or what do you guys think about these individual financial traps and how do you navigate them? But other than that, I appreciate you guys for watching this video. I'll catch you guys in the next one. I'd appreciate a subscription and a thumbs up. And I hope you guys have a great rest of your day. See ya.